All right, so today we're going to be looking here at Chapter 18. So in Chapter 18, we're looking at cost, volume, profit. So the first thing we want to look at here is how do we identify different types of cost behavior and why might we need this information? So the very first thing here is, well, we might want to answer these types of questions. Well, how many units do I need to sell to break even? Now, of course, my goal isn't to actually break even, it is to make profit. But in order to do that, I have to know how much I must sell to avoid losing money. And that is what we call the break even point, right? It's where our sales is equal to our total costs. Now, how much does income increase if we install a new machine? So we're going to perhaps have more fixed costs, but we are able to reduce labor costs. So we're giving up some variable costs, trading them in for a certain amount of fixed costs. How does that affect my actual income? We might want to see things like, well, what is the change in income if selling prices go down? So we drop the price, but we increase the actual quantity sold. So we're looking at things like elasticity, perhaps. We may not call it that, but of course, that's what we're looking at here. We see things like, well, how does income change if we change the sales mix of our products? So certainly another thing we can consider. So maybe I want to boost advertising for one product over another now to try to shift my sales mix around. That's certainly something we can do. And next, of course, what sales volume is needed to earn a specific amount of income? Now, of course, this isn't an extensive list or an all-inclusive list, but hopefully this gets you thinking down the line of what we're really looking at in this chapter. So there's quite a few things that we're trying to analyze, and this chapter is all about understanding how these things tie in. So in this case, we see some charts here about fixed costs. You will notice in this top chart, we have our fixed cost graph. It is this bright orange line going straight across. You'll notice that regardless of the volume, the actual amount of fixed cost is the same. And that is because within what is called the relevant range, that fixed cost will not change. This lighter orange line down below we'll deal with on the next slide, but this is our variable cost line. And when you add the two lines together, you get your total cost line. Okay. Now, this bottom chart shows you your actual fixed cost, but on a per unit basis. So you'll notice that as you come down, right, so as you increase volume, your fixed cost per unit starts to decline. And it does so at a decreasing rate. So for example, if you only produce one unit, you have to cover 100% of the fixed costs with that one unit. But the second you produce a second unit, now you only have to cover half the fixed cost for each unit produced. Now, when you produce a third unit, you only have to cover a third of the fixed cost with each unit produced. So you see that that amount that is having to be covered is in fact coming down, but it is coming down at a slower and slower rate. Now, eventually this basically flattens out because you start to spread this fixed cost over so many units, the amount almost becomes negligible on a per unit basis, which is what we are trying to see. This is why you see things like economies of scale actually happen, is because the fixed costs are only being incurred once. So even though you're ramping up production, you're not seeing a whole lot coming through on that fixed cost side because it's spread out over such a large quantity. Now, we talked about variable costs a second ago, so here we go. Here's the actual graph for them. So here we are concerned with this pale orange line. That is my variable cost line sloping up from the bottom. We once again see our fixed cost line in the bright orange going straight across. And finally, we see our total cost line here coming up as the sum of the two. So with our variable cost per unit, you'll notice in this case, we're looking at this line, right? That goes completely flat across the horizontal axis, right? So however much my variable costs are for one unit, we assume that they will be the same cost for each individual unit. This makes our lives a little bit easier, and it means that variable cost per unit is a consistent cost on a per unit basis. Now, all of this is stuff we've seen before in the semester, but it's worth rehashing before we get into this chapter. Now, we're going to have to talk here about something that is called a mixed cost. So a mixed cost is something that has both fixed and variable components. So you might see something like a utility bill here. Okay. Is your utility bill going to change because of the amount of electricity you use? Yes, that piece is variable. But if you shut down your factory for the month and produce exactly nothing, you still probably owe something to the electric company. And that's for the wires and everything that they've run out there and the fact that they offered you power. Right? So there's a fixed portion of that bill. So you may see this as a as a mixed cost, right? Part of this is fixed, right? That portion that doesn't change regardless of your usage. And then part of this is variable, the part that depends on the number of kilowatt hours you use over the month, for example. Okay. Now, our next cost here is what we call a stepwise cost. So total costs increase to a new higher cost and then are once again fixed. So in this case, you will see what we call here a stepwise fixed cost. So within this first range from 0 to about, I don't know, 600 or 700 units, you see that our cost is fixed at $20,000. Then from either 600 or 700, wherever that line actually hits, all the way over to just under 1,400, you'll see that we're fixed again at 40,000. So maybe for this first run to get up to this, say, 700 units of production, I only need one production manager. That production manager, I pay $20,000, right? But if I want to run a second production shift, I need a second production manager. So that I will bump by the full cost of another manager's salary or another manager's pay, and that'll throw me into this new level until I need a third shift manager when I'll jump up again. And so this is the idea of a stepwise cost. Now, our last type of cost here is a curvilinear cost. So you'll notice a couple of things about this chart. You'll notice that on the left-hand side, if I look, so we'll actually draw this out real quick. On the left-hand side, to go from 0 to say 200 units of production, I need a very small increase in cost relative, right? So it's this very small change. But on the other side, if I want to go from 1,800 units to 2,000 units, you will notice a dramatic change in the level of cost, right? And the idea here is this might, for example, represent something like direct labor. And you say, well, how does that represent direct labor? Well, here's the way this works. I want you to imagine you run a phone company, right? So you're a telemarketing company. You're calling people all the time, right? That is your company's job. You just call people, cold calls all day long. Well, at a certain point, right, at first, if you've only got one person, but you got, say, 10 phones set up, every person you hire is going to add a lot to this production because now that phone is being used. So you see this large jump in productivity very, very quickly. But what happens when you hire an 11th person? Well, there's only 10 phones. So that 11th person, by definition, can't be as efficient as the other 10. So what they might start doing is pulling customer lists for the other people, getting them coffee, doing various things to help speed them up. But in and of themselves, that 11th person is not that efficient. Well, if you continue hiring 12 people, 13, 14, 15, 100, eventually you get so many people in there with so little equipment that they just can't operate. They actually start to get in each other's way. And this inefficiency creates this huge jump in cost that we see over here on the right-hand side. So for the same change, 200 units of production, right, where before this was a very low cost, now we're seeing a tremendously large cost on the right-hand side. And that's because we don't have enough factors of production at that point to use things efficiently. Now, the next thing that we want to look at then, oops, let me clear out our annotations. So the next thing we want to look at here is called measuring cost behavior. We've got three different areas here. We've got a scatter diagram, we've got the high-low method, and finally we've got regression. Of these three, I bet you can guess and know that in this case, regression will be the best method. We will, however, not be covering very much detail on regression in this course. It is an advanced method. You will see regression plenty. If you move on into cost accounting, I believe it is covered there. And if you don't, you'll actually see it covered in economic statistics or in applied statistics. So you will get a taste of regression. I think it's very useful that you understand it. If you are an accountant, I think it's very helpful to know. Very few accountants on the whole actually truly understand how regression works. So if you are one of them, it gives you a huge leg up as you start to move into managerial positions later on. So first option here is a scatter diagram. It works pretty much the way a scatter diagram has worked forever. So you're going to plot all of your different volume and cost points. You'll then try to find what's called the line of best fit, and that will give you a formula to estimate your costs. So that's pretty much all there is to it. Now, for the high-low method, we see here, they give us a bunch of information for all 12 months. They tell me the number of units produced and the total cost. Under the high-low method, you must figure out which month has the highest and which month has the lowest. But the question is the highest and lowest what? So is this the highest and lowest cost or the highest and lowest volume? So what we need to base this on is the amount of volume, not the cost, right? While it may be true, the highest production month has the highest cost, it also may not be. So in the case that you have differences in there, you will be basing your decisions on the highest and lowest levels of production, not on the amount of total cost. So in this case, we're going to look and we see, if we go back to that previous page, that November had the highest volume level and June had the lowest. So June had only 17,500 units produced, while November had 67,500 units produced. So we're going to come in. We figure out our change in units and our change in cost. Just like we always see, anytime we start to calculate a slope, it will be change in y over change in x, so change in cost over change in volume. So that $12,500 change divided by the 50,000 units tells me that each unit costs 25 cents under this method. Well, now I can plug this back into either formula, and I've got total cost in one case. So for November, I had total cost of $31,000. And we remember that total cost is essentially made up of two pieces. Part of that is fixed, part of that is variable. So what we just figured out was that with the month of November, we produced 67,500 units. And if each one of those incurred 25 cents of variable cost, that tells me that of the $31,000, 16,875 must be variable, meaning the remainder, that 14,125, must be my fixed cost. Now with this cost equation, I can figure out for any volume level what I project my total cost to be. And this works pretty well. Now, this is a very easy method. Because of that, though, it is not the most accurate, right? It's quite easy to implement, which is why we like it. It's pretty quick to do. It's not that challenging. For those reasons, this does get used on occasion in practice, but it is certainly not the best method. The best method is the one that, sadly, we don't really get into in this course. We could have an entire course just on regression, and it would be a fantastic thing to do. But in this case, we've got too much other stuff to really delve into. So we're just going to mention that regression is the best of these options as long as you set it up well. But the good thing about regression is it actually has a way to grade itself. If you're using only one variable and you run a regression, you will be basing your decisions on what is called the R-squared value. It tells you how much of the variation in cost, in this case, is explained by your variable. If you are using more than one variable, R-squared will not work. In this case, you will have to use the adjusted R-squared value, and that would tell you how much of the percentage change in cost was actually explained by your variables that you pulled in. And the reason this works so nicely is that if you start to put in things that actually don't work, your adjusted R-squared will actually come down. And as you start to streamline your model and get it more accurate, your adjusted R-squared will go up. Ideally, you would like to see this adjusted R-squared value hit 1, which would be 100%. But of course, it's very, very unlikely you'll get there. But the higher this gets, the better off you are, the better the model you have. Now, within regression, you're also going to want to look at things like multi-collinearity, where your variables may measure the same thing in different ways, but your model doesn't really know what to do with that in regression. And so it actually will hurt your model if you find variables that are too closely related. So for example, if I'm looking at pricing on houses, I can't measure the number of rooms and the square footage, because my interpretation would be something like, for every room I add while holding square feet constant, then the price of the house should go up by X amount of dollars. Well, the only way for that to work is for you to just throw up a wall every 3 feet, right? And in truth, that wouldn't work, right? Your house would be far less valuable if it had 1,000 rooms, but each one was 2 feet square, right? It just doesn't work. And so you have to be able to see in your model development, do these things measure the same area? And if they do, you need to pick one or the other. And that's what you need to understand. So regression, a lot of good stuff here, a lot of fun to play around with. I strongly recommend, if you're going into accounting, you spend some time really understanding and really paying attention in the courses where you really get to play with it. But otherwise, for here, just know it is a good method. It will possibly pop up, but really the same thing here is true. We're just trying to determine the split between variable and fixed. So under my regression method, when the textbook actually runs this regression, what they find is that we have fixed costs of $16,688, and we actually have variable costs of only 20 cents. And because of this, it tells me then that my actual per unit cost, my variable piece of that, is considerably lower, which is going to be very useful information for us. Now, for our next area, we need to look at contribution margin on a per unit basis. So I believe we've looked at contribution margin before. We just call this selling price or total sales minus variable costs. Here, we're actually bringing this down to a per unit level. So selling price per unit minus the total variable cost per unit. Now, once we've done that, we can figure out what is called our contribution margin ratio. So this is contribution margin per unit, which we just calculated. So if you want to rewrite that as selling price per unit minus total variable cost per unit, you can, divided by that sales price per unit. So in this case, we are told we have a selling price for each unit of $100 with a variable cost of $70, giving us a contribution margin on a per unit basis of $30. This will give you the contribution margin ratio of 30%. Now, while that is useful, it's not everything we need. So in this chapter, one of our main concepts will be this idea of computing break-even point for, in this case, a product or a company with only one product. Now, how many companies do you think exist that sell exactly one version of one product? I'm going to say not very many, right? Probably none. So what we need to understand, right, starting out in this chapter, we're going to look at a single product company. Toward the end of the chapter, we'll deal with a multi-product company, which is more realistic. But we're going to get our feet wet here with this break-even point for a one product company. So just general things we need to understand about break-even point. This is the sales level at which total sales equal total cost. So it is when we have net income equal to zero, right? Total sales equals total cost, so there is no income. And because of this, the company will not earn a profit or incur a loss. And what's really good about this is we actually can calculate this in two ways. One way I can calculate this will give me my answer in terms of units. So how many units do I need to sell to actually break even? Another way that I can calculate this is in terms of dollars. So how many dollars worth of sales do I actually need to generate a profit of $0? We've got three different methods here. We've got the formula method, the contribution margin income statement method, and then the cost volume profit analysis chart. So I think of these three, the last one is the easiest to see this with, but the first one is probably the easiest to do this with. So let's see how this works. The formula method gives us two different formulas. So if I need break-even point in units, this is how this works. I will take my fixed costs divided by my contribution margin per unit. And you say, well, why is it divided by contribution margin per unit? Remember, what is included in contribution margin per unit? If we actually go back just 2 slides, I believe, 3 slides, we'll see contribution margin per unit is actually that sales price minus variable costs. So we've already dealt with the variable piece and we've already factored in the sales price. So the only thing left at this point is to deal with those fixed costs. And the only way to do this is by taking my fixed costs and dividing by that contribution margin per unit. This will tell me how many units I need to sell in order to break even. Now, on the other side, if I need my break even point in dollars, I will come in. I will take my fixed costs, but notice here, I'm not dividing by my contribution margin per unit, right? Instead, I am dividing by my contribution margin ratio. And when you do this, you will come out to $80,000. Now, I think there is another way to get break-even point in dollars, and it works if you've already calculated break-even point in units. So if you know that you can take your break-even point in units of 800 units per month, we do have a selling price for those units. In this case, we were told it was $100. Well, 800 times 100 is 80,000. So if you take your break-even point in units times your sales price per unit, that will also give you break-even point in dollars. So here, the textbook doesn't show you that method, but of course it is an option. Now, our next method is the contribution margin income statement method. So the way this works is essentially we start at the bottom and we go straight up. So if my income has to be zero, and we know it does because we're calculating break even. And by definition, break even is when income is equal to zero. Then I will know what my fixed cost level is. So I will see fixed costs of $24,000. That will tell me my contribution margin had better be $24,000 because my contribution margin better equal my fixed costs. At that point, we can then figure out my variable costs and my sales by simply solving up. And we'll do this in class several times as we prepare different contribution margin income statements. So I wouldn't be too concerned about it in this video, but we'll certainly do this together in class. So as you run into questions on the homework or as you run into different things, just go back to our notes from our actual in-class time. Now, for our next area, we want to look at our cost volume profit chart. So in this case, we're just graphing. So I'm a very visual person. If I can see it, it makes so much more sense than if we just talk about it. So I think this cost volume profit chart is really useful for many of us. Here's the way this works. If you see your red line, so let's just look here. So we see our red line. So right here. Well, now it's blue, but this line, if I could draw straight, right? This is our line that indicates our total cost. That total cost line is what we see for the total cost of producing and selling that number of units. So at any point when my total cost line, in this case that red line, is greater than my total revenue line or my total sales line, that green line, then I will incur a loss. And that generates what is called the loss area. And is this box here. Anywhere up until the point where those two items meet. Anything in this region is generating an overall loss. Now, anything in this next region is generating profit because at this point, my total sales exceeds my total cost. So that is our profit area. On the other hand, our last piece here involves our break-even point, and it is this exact point where those two areas come down to zero. So it is where my total expense or my total cost line here meets with my total sales line. This exact point right here in the middle is break-even. And so that in this case is our 800 units. So if we sell less than 800 units, we have a loss. If I sell more than 800 units, I have profit. And if I sell exactly 800 units, I hit break even. Now you can do the same thing, of course, with sales dollars. So if I sell anything less than $80,000, I have a loss. If I sell anything more than $80,000, I have income. And if I sell exactly $80,000, I will hit break even. Okay. So I think the graph is pretty nice. I think it helps you really see what is going on here. But if it doesn't, if you don't like it, I wouldn't spend too much time on it. Probably the hardest thing I could give you with a graph like this is just having you label the areas, right? So here's your loss area, your profit area, here's your total cost line, your total sales line, and break even. If you know those things about this, I think you'll be just fine. Okay. Now, the next thing that we want to look at is, well, how do changes in estimates affect things like break even? So in this case, management comes in and they're actually going to make several estimates. In this case, we've got an optimistic estimate, a most likely estimate, and a pessimistic estimate. So what we want to see is, well, what if we have some weird combination of this, right? So what if I think I can actually increase my selling price from $100 to $105, but I don't think there's going to be any change to variable cost per unit or fixed cost per unit, or those total fixed costs, right? So I don't expect any changes to anything else. I just expect my price to be able to go up 5%. Well, in that case, I can calculate revised break even by taking my $24,000 in fixed costs, dividing by my contribution margin per unit. That selling price of 105 minus my variable cost of 70. That gives me a contribution margin per unit of $35, and 24,000 over 35 is about 686. So these charts down here at the bottom just show us what is actually happening over time. So let's look here. If I zoom in, it'll let me. So if I come in and we see that I raise my price, my selling price per unit. As I raise my selling price per unit, the number of units I need to sell to break even is coming down. So when I'm selling at $95, I need about 950 units to sell in order to break even. But when I sell at $105, I only need about 700 units to break even. So we're seeing this, and that seems to make sense. The more money I can make on each sale, the less units I have to sell. Now on the other side, as my variable cost is increasing, so my variable cost is going up, you'll notice that means my contribution margin per unit, assuming selling price isn't changing, is going down. And because of that, the number of units I need to sell to break even is actually increasing. So when my variable cost per unit was $68, I only needed about 750 units. But when my variable cost jumps to 72, I now need to sell a full 100 units more in order to have break even. Now, in our last example here, we'll see, and go ahead and clear our drawings real quick. So in our last example, we see that we are looking at the change in fixed costs. So you'll notice as my fixed costs are increasing, so too is the number of units I'm having to sell in order to break even. And that is because this top piece is getting larger. So I'm having to cover more fixed costs. And because I have to cover more fixed costs, I have to actually sell more units to do so. So this is what we're seeing with each of these graphs down here at the bottom. I think they are pretty good. I think they help us understand what is actually happening here and see those actual relationships. Now, the next thing we want to look at is what is called margin of safety. So we have margin of safety. We can calculate this in terms of percentages. This is expected sales minus break-even sales over expected sales. So in this case, 100 minus 80 over 100 is 20%. So what I'm seeing here is how much can my sales decline in terms of percentage before I start losing money, right? So we want this margin of safety to be incredibly large, because if I have a margin of safety of say 80%, I'm pretty safe. But if I have a margin of safety of like 3%, I'm pretty nervous, because if anything little even disrupts us at all, then I may start losing money pretty quickly. So this is especially important now when we've got this pandemic raging, because if you did not have a sufficient margin of safety before, you may start incurring losses, or you may have already started incurring losses at this point. So this margin of safety is very important because it serves as kind of a bellwether of if you're going to be able to survive a really difficult time ahead. Maybe you can, maybe you can't. But if you've got this large margin of safety, you got a much better chance, because if you take a hit on sales, you're still profitable. And that's what we're wanting. Now, in this case, we can compute income from sales and costs. So coming in, we've got our contribution margin income statement. So we see here we have sales of 1,500 units at $100 a piece. That is $150,000. Variable costs coming in at 105 gives us a contribution margin of 45,000. Backing out our fixed cost of 24 gives us pre-tax income of 21. Now, we can also do this for an after-tax situation. So we come in, it's essentially the same table. The only difference here is we're told we have an income tax rate of 25%. So we'll back out that 5,250 coming down to the 15,750. So basically, depending on what I ask you, it tells you which direction you need to solve this. If I ask you to find income, you just go straight down the way we normally do. But if I ask you to find sales, you're actually going to have to come up. And we'll do that, of course, either in the homework or we'll do it in class. So we'll actually see some examples of that. Now, in this case, we want to compute sales from target income. So how much sales do I need to generate this level of income? Well, I need to take my fixed costs. I'll add to that however much I want my target income to be, and I will divide by my contribution margin ratio. So in this case, I had fixed costs of 24,000. I want target income of 12. That is 36,000, and 36,000 over 30% is $120,000. If I want to compute sales for target income using units, then I'll simply take my fixed costs plus my target income. You'll notice the numerator has not changed, but now I'm dividing by the contribution margin per unit of $30. This will give me 1,200 units. In this case, I want to actually compute sales. So we take our target income of 12,000, our fixed cost of 24. We solve up, that gives me contribution margin of 36,000. I then take advantage of the fact that I understand I've got a 30% contribution margin. So 36,000 divided by 30% gives me sales of 120, which allows me to find my variable costs of 84. Now, in this case, we'll be looking at evaluating different activities or different strategies. So if we want to calculate what's called a revised break-even point in terms of dollars, we'll take our new fixed cost amount. Let's say that has changed now from 24 to 30,000 divided by my revised contribution margin ratio. So I've increased my fixed costs, but I've decreased my variable costs. So maybe I bought a new machine, fixed, but it's allowed me to have less workers, variable. So I'm boosting my contribution margin, but I have now changed my fixed cost structure. At this point, my revised break even is $75,000. Before, I believe that was $80,000, so it does appear that this has been a good decision. Now, here toward the end of the chapter, we see a couple of things. We now need to deal with the fact that most companies, in fact, almost no companies, actually sell exactly one type of unit. So instead, we need to look at what's called sales mix and break even. So the cost volume formulas can be modified when we sell more than one product. So instead of what we've seen so far, we're going to see how composite units work. So the unit contribution margin is instead replaced with the contribution margin for the composite unit. This composite unit is composed of specific numbers of each product in proportion to the actual product sales mix. And we'll see this worked out in just a second. Now, the sales mix, of course, is just the ratio of the volumes of the various products being sold. So the resulting formula that we need here, fixed costs divided by contribution margin per, notice, composite unit, not per unit, but per composite unit. So in this case, Hair Today offers 3 different haircuts as shown below. Annual fixed costs are $192,000. They want us to compute the break-even point in composite units and in number of units for each haircut at the given sales mix. So the company has told us we typically sell, for every 7 haircuts we do, 4 of them are basic, 2 of them are ultra, and 1 of them is a budget cut. With each of these, they have come in and given us the selling price and the variable costs, allowing us to calculate the unit contribution for each one. At this point, we simply need to come in, take my actual information and multiply it all the way through. So in this case, for my basic, I've got a selling price of $20. I sell 4 of these. So 20 times 4 is 80. We do the same thing. 32 times 2 is 64, and 16 times 1 is 16. This is a total selling price of $160. We'll now do the same thing for the costs. So a basic haircut costs $13. 13 times 4 is 52. Adding up is 96. 160 minus 96 is, of course, 64. Now, that is one way you can do this. The other way you can do this, simply come in, look at this table. 7 times 4, that is 28. 14 times 2, that is 28. 8 times 1, that is 8. 28 plus 28 plus 8, this is also 64. So, however you want to do this is fine. If you want to do the selling price times your sales mix, and then your variable cost times your sales mix and subtract it, that works. If you would rather do this in one step by taking your unit contribution times your sales mix and adding that up, that works. Whatever you are more comfortable with is fine with me. Just make sure you understand how this is working. Now, at this point, we need to actually calculate my break-even point in terms of composite units. So I'll take my fixed costs over that composite contribution margin. So 192 over 64 tells me I need 3,000 units. But notice these are composite units. So now I need to figure out, well, how many of each type of haircut do I need? So if for each composite haircut, that includes 4 basic haircuts, 1 budget haircut, and 2 ultra haircuts, we will need 12,000 basic, 6,000 ultra, and 3,000 budget for a total of 21,000 haircuts in order to break even. We can see this on what's called a multi-product income statement, where we take each type of product, give it its own column, and have a total column here at the end. So for my basic, we see our contribution margin 12 times 7 is 84, 84, 24. 84 and 84 is 168 plus 24 is 192. 192 minus 192 is 0 for net income. Now, a couple of things we need to be aware of. There are some assumptions that underlie cost volume profit analysis. 1, cost can be classified as variable or mixed, right? I'm sorry, as variable or fixed. There are no mixed costs here. Costs will be considered linear within the relevant range. All units produced are actually sold is another assumption we are dealing with, and our sales mix is constant. It is not fluctuating. So in practice, some of these more or less reliable than others, but certainly things we need to be aware of that are built into this. Now, one of our very last topics here is what is called the degree of operating leverage. So this measures the extent to which fixed costs are being used. So this is simply telling you how a percentage change in sales will impact profits. So our degree of operating leverage is going to be equal to total contribution margin in dollars, right? Not contribution margin per unit, but in total, that total contribution margin divided by our pre-tax income. So in this case, we see we have sales of 1,200 units at $100 a piece is $120,000. Variable expenses were $70 a unit. Well, $70 a unit times 1,200 units is $84,000 for a contribution margin of 36. Our fixed expenses were 24, giving us pre-tax income of 12. 36 minus 24 is our 12. Now, at this point, we need to calculate my actual degree of operating leverage by simply taking my total contribution margin of 36 over the 12, which is my pre-tax income, and that gives me a rate of 3.0. Now, this 3.0 is exactly what it sounds like. It is essentially a lever, right? Levers make things easier. Levers help you make large changes very easily. So this degree of operating leverage is essentially telling me for every 1% change, I will see an impact of 3%. So for every 1% change in sales, I will see this percentage change in income. Now, in this case, they asked me if Rydell increases sales by 10%, what will the percentage increase in income be? Well, my degree of operating leverage is 3. My change in sales is 10%, giving me a change in income of 30%. You said, well, that sounds great. I only need to increase sales by 10% to increase income by 30%. And I say, you're right, that is true. But what's the downside of this? Well, if your sales decrease by 10%, your income decreases by 30%, right? It works both directions. So while it can be very beneficial if you have a high degree of operating leverage, if you are successful, right, you can make very, very large amounts of profit very, very quickly, right? If you had a 10 here for degree of operating leverage, a 10% increase in sales would result in a 100% increase in income. That sounds amazing, and it is. But of course, the downside is losing even only 10% of your sales results in a drop in income of 100%. So you have to be very careful. Certainly something to know of, certainly something to be aware of, but definitely a powerful tool. Now, the last couple of things here are in the appendices. One is using Excel, using the intercept and slope formulas. If you want to look at that, feel free. The other, of course, is talking about variable costing and performance reporting. This is Appendix B. I'm not going to worry too much about it. If you want to read through it, feel free. Otherwise, if we need to talk about it, we'll do it in class, but I don't expect we'll talk about this in this chapter. So with that, we have eventually hit the end of chapter 18. So if you have any questions, once again, please do not hesitate to reach out to me and talk to me. I'll be happy to talk with you about it and help you understand. But I only know if you need help if you tell me. So please, please, please don't wait until it's too late to get help. Get help now, get help early, get help often. Either come by me or go see the art. But make sure you're getting the help that you need to be successful in this course. We'll see y'all next time. Thank you.